if I'm back live. I think I am. All right, let's have some fun tonight. Yeah. All right, all is good. Take two. Sorry about that. We'll edit this after the fact. Hopefully, it's easy enough to edit out the stuff that was bad, and we'll pick up from there. I'm going to wait for some viewers to hopefully trickle back in here. All right, chat, for real. How we doing? Yeah. Back at it, live stream. Got a lot I want to talk about tonight. I think the main theme for tonight is going to be going from the underlying dynamics, like the MMT dynamics, to building out an investment, like an investment case. That's kind of what I want to aim for. I'm going to try one more thing. Let me know if anything happens here from an audio perspective. If it messes things up, please let me know. Man, they one of the newer updates in OBS really killed one of the main functionalities that I use, and that's no fun. Oh well. No, I can. Oh, that's so much better. Okay. All right, guys. I'm really sorry about that. I do think that I'm where I want to be now. So let's get rolling. Hey, hit that like button as well while you're there before we get rolling here, because that will greatly help the algorithm recover from this not so fun start. All right, so what do we want to do today? What we want to do is go over some tweets, some flows, some ideas that we've been talking about recently. Mainly, I tweeted out earlier this day ago now. Yeah, 2 days ago now, this chart right here, where I was explaining that the fundamental driver, kind of the first cause of the credit cycle, is fiscal, and that from there, once the fiscal hits, this starts this credit cycle, and there are ramifications, feedback loops, dynamics that are at play that really end up defining the credit cycle itself. And I had some good feedback on this tweet, but really, this helps you get to kind of the essence of the business cycle itself. It also, it doesn't necessarily translate immediately to investing and how you'd want to be positioned, how you'd want to think about this as an investor. So it's kind of the bridge I want to get over gap, but we really have to kind of build back up the theory and why this works. Now, if you've been around these neck of the woods, some of the stuff is going to be kind of 101 and immediately understandable. But I, again, for the sake of this video and kind of what I want to do, I want to build out kind of from the ground up here. And there are two ways that I like to look at kind of how this is all playing out. And the first is, when the government spends, I mean, if you just think about it from the private sector standpoint, and if you're willing to just maybe I need to do more convincing here if you're, maybe on the fence, but if you're willing to just kind of accept the core MMT idea that when the government's spending, it's adding financial assets to the private sector, then what that means, what it means to add a financial asset to the private sector is the first step is literally just use reserves, create reserves to buy whatever it is that the government is buying, right? So if you're a widget factory and you manufacture widgets and the government comes and says, hey, I need some of your widgets, what is the first order effect, the first step is that reserves are going to be transferred from the government to the widget factory, right? Now, if the widget factory, if we combine all output into just one, the aggregate output, right? The macro level output is just that widget factory, and the government is buying that widget. And assuming that this really simplistic model that there's $1 markup for each widget, and that's going to be the profit margin on that widget, and the government buys a widget, that means that the widget manufacturer made $1 of profit. And if you're tripping up on this and you're like, hey, wait a second, did they have to borrow this money? No, that's the whole point. And that's like the whole MMT. I mean, if you can at least understand the mechanics of when the government is buying something out of the private sector, that it is an asset, as a financial asset swap for a real asset swap, and that the net effect is a net financial asset creation for the private sector, then you can understand like this simple point that it's a profit for the private sector, right? So when the government spends, it's literally adding profits to the private sector, assuming the private sector is not selling stuff at a loss to the government, which if the government comes knocking for your stuff, don't sell it to them for a loss. They can afford it. As it turns out, they can afford it. Sell it to them for a profit. And that actually benefits the entirety of the macroeconomy when when in fact you do that, right? Like, and this will make sense in just a minute. Michael, welcome, by the way. Thanks for saying hi, man. Thanks for joining. So, that is like the first effect. I mean, there are two immediate effects, but that is like the first effect is that you're just adding profit to the private sector. And if you think about it, if you are a company and you are generating profits, especially if you're a corporation that's publicly funded or that's publicly traded, you are obliged to continue to seek more profits. And the only way you can then get more profits is to make more widgets or increase the cost of the widget that is being produced. And so in order to do that, obviously you can just increase the cost if you just want to increase your profit margin. But if you want to increase output, right, you want more to consume, you understand that there's enough demand and you can't keep that demand, then you have to invest. And you have to invest in new production. And what ends up happening is, of course, the government's not going to pay for that investment, right? But you now have to go out as the business, and again, if you think about this in the aggregate at the macro level, you, the widget manufacturer, have to go out and buy a new widget manufacturing piece of equipment. And let's just say this manufacturing piece of equipment cost $1 million. You haven't made $1 million of profit yet. To pay for that, how do you do that? You go out and you get a loan, right? So you're going to get a loan, and that's going to allow you to create now more widgets. When you get that loan, and this is kind of the almost the magic of kind of the post-Keynesian business cycle. When you create that loan, you are actually creating new money to facilitate that transaction. That is kind of the wild thing about banking and kind of the post-Keynesian process. And I can kind of show this. I can sketch this out real quick. If we'll have this be the machine maker, or I guess the widget machine maker. Widget machine maker, and let's just say this is the widget machine factory. This is the conveyor belt that's going to kick out the widgets. There's going to be a bank, and there's going to be you, which you are the widget producer, right? You're actually going to produce the widgets, and what you want is you want this machine as an asset for yourself to produce the widgets, right? Because you want to increase your production. You already have one. You already have one of them. You want another one, right? And so, whatever manufacturer makes these things, you want that. So in order to facilitate this exchange to get the second one in there, what ends up happening is the bank is literally going to create a loan, and this is going to be a $100 loan. And this loan becomes your liability, but there's also an offsetting entry where this loan becomes the deposit of the widget maker. So now we can do the financial asset swap for the real asset swap, which is now you have these two widget maker machines. You don't increase your net worth any because you now have the $1,000 or the $100 loan that was what was necessary to buy the widget maker. the widget maker reduced their real wealth because they don't have this widget machine anymore, but they likely sold it for a profit. And this, they do increase now their financial wealth, right? And the bank is just facilitating this by creating the money. If you roll back the tape, you'll notice there was no money in this system, but now there is. And so we've created the money to facilitate this real for financial transaction. And now we have, new money in the system. And this all kicked off because the original step was the government came in and went into $1 worth of debt to buy that original widget that then sent the signal to you to start to actually want to produce more widgets because you had this signal of increased demand, right? And so the initial step is to increase investment. This is why you see the causal link between government spending and credit acceleration. Is it all has to do with the fact the private sector as a whole is getting the signal that demand is increasing, and that signal, it comes in the form of a profit, right? So that is the first step. Jesus, is just record keeping or score keeping. Yeah. It at the financial level, it's all score keeping, and this so many people get. There's a person. I assume they're a guy, so I'm going to call him a him. But he's on Twitter, like 20 economic lessons or something, and I mean, you get this a lot, even in kind of the post-Keynesian MMT world, where so many people, and the Austrians will come back and say the exact same thing, where they're like, well, no, you're not accounting for the real asset swap that took place. You're just looking at the financial side. Well, yeah. That is what the financial economy is. I mean, that is what capitalism is. It's just one big scorekeeping game, right? No one actually invests based on the real output of any company. They're not. I mean, in one sense, they are. They want to understand what the impact of Pepsi is or Google is or whatever, the real impact that they want. But you're not going to come up with a valuation of a company solely based on the real output and the utility, the value of that real output that you see. You're going to do it. You're going to price it all nominally in financial terms. Capitalism is a game played with numbers, not a game played based on my own felt sensation of how important a widget maker is. That is what's happening, if you will, underneath the reality of the scorekeeping, but it's the scorekeeping that is the game that we're all playing, especially when it comes to kind of investment and where you're going to put capital to invest. That's a really important point, and something that I don't see enough people having the separate categories for, right? The bifurcation between real and nominal. And I'm not trying to say that the real outcome isn't the outcome that we actually care about. It is the outcome that we actually care about, but you can't understand the dynamics of that real outcome unless you understand the kind of scorekeeping numerical dynamics that we use to describe what that is. So, I hope that helps at least get your mind wrapped around what my mind is wrapped around in terms of how I'm going to understand this, because at the end of the day, all I care about and the only thing I can really measure is the actual money and the flows that are happening is some sort of representation of what's happening in the real economy. And that's what I can forecast. It makes no sense to me as someone who's trying to understand how markets are going to play out and position myself for that to forecast some felt response, like how good is society going to be when AI finally becomes this kind of takeover tool or something, right? I don't know. I mean, that's a utilitarian question, a philosophical question, and those go into places that we're all going to have our own opinions on, and it doesn't really matter, and it doesn't change anything in terms of the outcome. What I care about is, what do these flows look like? What do they do? And what information is being communicated to the private sector and its behavior from the various flows that we're able to track. And in this case, when the government spends, that's just net profit. It's just adding profit to the private sector. Yeah, Michael. I mean, that's a great way of putting it. I'm gonna switch back to chat here. I saw some good chat stuff come in. Let's see. We have widgets. Sprockets are the future. Invest in sprockets now. Let's see. Do I have this working? I don't, unfortunately. I have the overlay. So we don't measure real widgets to find the value. We use nominal financial numbers to figure out a way to best allocate capital. Yeah, I mean, it's the only. Yeah, exactly. That's the only game to play. Ty, that's a great way of putting it. All right. So I think we've drilled home the profit side of this. Let's now go back and think through the second part of this. And the second part of this is going to be the kind of capital base that the private sector is now going to leverage from. And this is where the idea of kind of like safe assets come into play, and what kind of the effect of issuing treasuries has to do with the overall kind of health of the banking sector. So in this world, we never introduced government spending. Like I did, in the sense of just saying that you got some money from the government, the dollar from the government, and that triggered this profit response, behavioral response. But now we need to actually bring this into the reality that these financial assets are being added to the private sector. And at the most basic sense, like assuming we had no laws that required the TGA to only spend out of what it can receive in treasury issuance or in tax receipts, and assuming we just skipped the repo step and the government was able to just straight up issue reserves directly, let's just say the government in this instance right here bought that $1 worth of widget. How that would end up looking out then, or looking like, is, and I'll change the color here, is that would end up being $1 of reserves, and that will also then be an additional dollar of deposits. And I'm going to keep these separate, because this $1 worth of deposit is your deposit, right? That's your profit. And this new reality now exists where, yes, there's a claim on that reserve, but this is a new additional financial asset that the private sector has that it didn't have before. And this ultimately does something special. And this is actually why I think you can make a really good case that, in fact, having the Treasury swap this out for a Treasury is actually kind of a good thing, because this Treasury now has, so instead of this being a dollar reserve, we'll just put the $1 Treasury here. This now issues interest, right? And so when I say then the next kind of step is that you have a kind of capital base that's getting built when the government spends, this is exactly what I'm talking about. The bank now has this interest-bearing instrument on its asset balance sheet that it allows it to use as kind of a collateral, or is just the capital base to now leverage from to make these loans, right? So that is the kind of next step in terms of why there is this causal link. If you think about it, when you go through a financial crisis, 2000, 2008, we'll even say 2022 to a certain extent, go a little bit further back to say 91. I know we had a few of them in the 80s and the 70s. When you go through a financial crisis, you need two things to happen at the exact same time. You need both the real economy to want to start to increase output again. And we just went through how it's going to pull that off. It's going to pull that off by the government spending and inducing this profit kind of demand, right? This upward virtuous profit growth, where the higher profits induce more investment, which induces more output, which induces more money being created. And remember, think back too, when this money gets created from the widget manufacturer creating the original widget machine that you sold, this money is now going to go to other workers, right? It's going to go to the rest of the economy where they can then buy the widget output as well. And so that's one engine that has to get started back up, because when this goes in reverse course, nothing that will ever, we saw this in Great Depression, this thing can reverse in perpetuity forever until you get the ample enough spending to reverse the flow of this dynamic. The second thing is, hold on one second, the second thing that has to play out, let me know in chat too if everyone's still there. I just had an interesting pop-up on my end. I think we're still good. The second kind of engine that needs to be restarted is, so there is the demand for the actual loans themselves, but then there's going to be the kind of supply side. All right, great, thanks, Michael. There's the supply side. Are banks even wanting, right? Does the bank want to give this loan? Do they feel safe to give this loan, right? Do they have the ample capital and the ample capital structure to do that? And the way that they get that going again is by getting risk-free assets that give a return to leverage from. And that's exactly what these treasuries end up doing. And that's why just kind of riffing on this point for a little while here, that's why when the government, or that's why when the Federal Reserve drops interest rates on these treasuries right here, when they drop interest rates to zero during a crisis, what they're actually doing is they are starving the banking sector of high return safe assets, right? And we'll dive into that concept in just a second, but keep that in the back of your mind that they are actually, now granted the value of the treasury goes up, but you're actually just creating a shortage of treasuries because you're making them more expensive when the overall supply of money is decreasing. So that's why I'm not always for crashing rates to zero to spur demand, because if you think about it, rates going to zero is not helping. If there are two parts to this engine, two engines that needed to get started back up, rates going to zero are not necessarily helping you. It's not giving the signal to you that there is more demand out there to want to increase into a second widget manufacturer. The thing that does that is actual demand, actual profit increase. 0% interest rates aren't going to do that when a credit cycle is collapsing. You need more spending to do that. That's why automatic stabilizers are so important. On the flip side, the 0% rate, and then the need, going back to the need and the idea of the capitalization of the banking sector, is they need risk-free assets. And so when the government is spending, it's doing both of those things simultaneously to get the private sector back off the ground, right? And this is why this correlation is here. This is why there is a causal step from government spending to the credit cycle itself. And it's all because of kind of the MMT post-Keynesian 101 concept that you're just adding financial assets to the private sector, right? And this is why, just to crap on them some more, but it's not just the Austrians. A lot of the neoclassical types are going to do this as well. We're not diverting, the government is not diverting assets out of the private sector when it's spending, right? It's adding, it's supplying the necessary assets for growth. And by growth, again here, I'm meaning nominal financial growth, not necessarily real growth. I'm not saying that every time the government spends and we get a booming business cycle, that is like what is optimal for society. I don't know what is optimal for society. That's, you figure that out. All I'm saying is, from a financial standpoint, this is the causal link. One thing that's worth kind of touching on too is, I'm pointing out that there is absolutely then this kind of causal link into, from, and it, I don't know what it takes, like 18 months or so from government to credit, but there is also the reverse causal link, and this shows up in the data as well. And a lot of people will point this out. How do you know what direction it is? Because if you think about it, there should be a causal link in the other direction as long as there are automatic stabilizers that happen, right? Because once credit drops, that means unemployment is going to skyrocket because the business cycle is coming to an end. And when unemployment skyrockets, there are automatic stabilizers. You get an unemployment check, and that fires off. That fires off, as you saw in 2000, 2008, 2022. That fires off the fiscal side, right? Stimulus will fire off the fiscal side, and so there's a reverse causal mechanism there. And the question is, well, how come it's not the other way around, right? That it's just some natural occurring event the business cycle just finally wants to pick up, and it all comes down to, well, it could be, and like if we had if we were stuck on a gold standard, it would actually be that, right? Or it'd be a lot more closer to that. People would go dig gold and then they'd stick it in a bank, and then a bank would feel more comfortable to finally spend. But since we understand the mechanics of a floating exchange monetary capitalist economy, we can figure out the actual causal mechanics, because it just can't happen the other way under this system, right? There's nowhere for the new demand to come from. There's nowhere from the new dollars to come from, and there's nowhere for the safe assets to come from. So that is, that is why we know the causal structure is the direction from government spending to credit. I see a super chat in here. Give me just a second to pull that up. Let me pop this out as well. And I don't think the overlay is working. Yeah, give me 1 second to get that overlay working, and then I'll bring this up. Let's see, overlay. I might not even have an overlay at all. All right, yeah, give me a second to get the overlay, because I do want these. Working. All right, hopefully that overlays. Yeah, all right, we got an overlay now. Okay, super chat. Thank you, Ukulele. Sorry if you already explained this. Why do you expect long yields to go down at low rate policy? Look at the UK. They've been lowering rates and long yields are going up because inflation expectation. Okay, really good question. Let me put a bow on what I was talking about real quick. Let me just make sure there are no outstanding questions, and I'll get to that. Banks are willing to give loans if the government guarantees them. That's what happens with mortgages. Banks were creating mortgages because government. Yeah, I mean, it does obviously help the banking sector if they know that the loans can be handed off to the banking or to the government sector. Let's see. Do you think that one could think of bank loans as leverage currency? Yeah, I think that's a perfect way of putting it. I'm completely fine with that. Okay, let's go to this idea of the yield curve. And I made a video on this. I think, are you Debate Cat, by the way, on Twitter? Because I think you've been asking me similar questions. And we can draw up a yield curve here. All right, so years, and we'll go yield. All right, you get the gist here in terms of the yield curve. Okay, that's helpful. Thanks for clarifying that. Your question is, yeah, I appreciate the trolls. I do, especially if it's like in good spirits. I mean, I can troll with the best of them, so it's all good. So the question is, what ultimately sets the yield curve, and the idea here is, I'm going to go like first order set and second order set. On the first order, if in reality, right, if the government could do this tomorrow, and it would wreak havoc for a couple weeks in financial markets, but in the grand scheme of things, nothing changes. If the government wanted to tomorrow, it could absolutely say, we're done issuing treasuries and everyone just gets reserves, and the banking system is going to get like 0.25% or something like that on reserves, and that's that, right? That's all we're going to do. We're no longer going to issue treasuries. We're going to get rid of the rules that force the treasury to issue treasuries to get back its reserves to then spend them again. We're just going to directly issue reserves. And if it were to do that, the outcome of the yield curve would no longer look like this. It would, well, I'll just get a different color here. It would look like this, and it would stay at 2.25% forever, and there wouldn't even be a 30-year yield because it wouldn't exist. All that there would be is the yield on reserve, right? And so if you're good with that concept to begin with, if you're okay with the idea that the issuance of treasuries is really just a preference of the financial sector for what it wants in terms of risk-free interest-bearing instruments, then the kind of second order is that the Treasury is just issuing these things to help the savings desires of the private sector. And so from there, then, what should we glean from the yield curve in terms of not only what it's telling us, but how can we forecast what the yield curve would do? Now, you can end up disagreeing with how you think things will end up playing out. That's completely fine. But the mechanics of what is actually happening is what an investor is doing is they're saying, okay, and for example, like why the short end would be compressing while the long end is going higher is what I read that to be saying is, so now we're going to, bring the short end down and it starts looking something more like this, right? So the short end stays low and then the long end ends up kind of taking off. What I read this to be is, hey, right now on the short end, so let's just say this is 5 years at this point, right? So this is the 5-year marker. On the short end, I have a strong feeling that rates are going to remain low, but I don't know what the heck is going to happen after 5 years. And certainly at some point, inflation, growth, whatever, are going to force the hand of the Fed to have to raise rates in congruence with their stated policy. Because the Fed's stated policy is if we get inflation, we're going to raise rates. They think they're fighting that inflation. Obviously, I don't think that that's what is actually going on. But in this scenario, that's how I would read this sort of yield curve right here. I guess the short end or the long end would probably end up doing something like that. And however, my argument would be is, and the argument that I've made, and I don't really follow the UK all that closely, and I don't know how they determine how the Bank of England ultimately determines rates and what sort of process that is. I really only understand what the Fed is doing. But the reason that I think we could end up seeing the entire yield curve collapse if it ends up becoming a thoroughly political, and I keep using this like voting box, ballot box decision, right, where the president just ultimately gets control of the Federal Reserve, right? If it just becomes the norm for the president to hire and fire Fed governors, to essentially force the hand of the Fed, if that becomes the norm, then you go back away from this idea of the Fed setting interest rates based on inflation and growth expectation. And instead you go to the Fed. Well, the Fed just doesn't have a decision anymore. It just becomes the policymaker, right? And my then kind of behavioral causal thought from there is, if it's up to the voter and up to the person that gets voted in to set the rates, do you ever think a president is going to get in office and say, yeah, let's just go ahead and raise rates through the roof? I mean, even in 2021, I couldn't imagine as inflation was rising that any president's going to say, yeah, let's just really hike rates up to 5%. Maybe they would be like, all right, whatever. If you've got to do 1%, do 1%. But in that world, in my mind, what ends up happening is you essentially just get a new policy regime where rates are just capped, right? You're never going to get anyone that comes in that's going to allow the Fed, once it becomes a policymaker decision, a president decision, or it fully goes back to Congress. I mean, just imagine if we got rid of the Fed and it was just now back up to Congress to set rates on the entire yield curve. You ever think? I find it very hard to believe that anyone would ever go to Washington saying, heck yeah, we need rates to go up. And with that in mind, rates then, I mean, this would be a norm that gets set forever, right? I mean, 30 years out, the expectation would be that the rates are never going to get risen, but the market will decide what they want higher risk premium because they expect higher inflation from lower rates. No, okay. There will always be someone, I mean, because the reserves are always supplied, right? And there's always the reserves that are there. The market, that's the point. I mean, this is where you and I just kind of disagree, is that the market ultimately isn't determining the rate. Like, I understand that an auction process takes place, right? And I understand that people that they're going to bid on the rate at which they want to be paid. But my point is, someone will always come in, like someone's always going to come in lower because the reserves are always being supplied and get it closer to what they think is going to be, essentially the break-even point on that individual bond that's going to get issued, right? So there's no way for the yield curve to run away once it gets communicated that interest rates are going to be stuck at zero forever. And I mean, an example of this is Japan. I mean, eventually the entire yield curve just collapses once it's realized that the policy is going to be ZERP forever. When we have a super debt auction, you will see yield spike. I bet any given auction, if I don't follow the auctions all that closely, I bet any given auction, yes, because it is an auction, a market dynamic, any given auction might spike. But what I'm saying is, over a 3-month period or whatever, enough reserves will get added to the private sector that will offset whatever short-term dynamics end up playing out, because there's this auction scenario that plays out, right? If only one person shows up, they're not buying though, because in that moment in time, the reserves aren't there, they're right, but it always comes back to, and it will always settle, and it always has in any country. In any country that hasn't abdicated the setting of interest rates or abdicated its kind of sovereignty, right, pegged to a different currency, that someone will have the reserves to come in and push the yield curve down. There is no such thing. Yeah, okay, I'm gonna pop these up. So how would I explain the phenomenon of bond vigilantes? There is no such thing. I mean, for 30 years, there were supposed bond vigilantes in Japan, and they all got destroyed. They call it the Widowmaker trade. Everyone in Japan got destroyed because Japan made it very clear that they were never going to raise rates, and there was no force for the rates to have to ever rise. And slowly but surely, the entire yield curve collapsed. There's no bond vigilante that exists. I mean, it is really only a fiction. There is always an additional add of reserves, and there will always be, if one auction happens where demand isn't quite strong enough, so it ends up spiking rates ever so slightly. And I mean, these spikes are minimal, right? I mean, it's not like it goes from 5%, 500 basis point to 600 basis points. It's tiny, and it's, the auctions are hit or miss, right? Yeah, I know nothing of the mechanics of the UK in terms of how I mean, I just can't speak on the UK. I can only speak to the US. It's my understanding that the Bank of England still has some autonomy, but someone else will have to step in to help me out. And I mean, I can look into the Bank of England maybe in between now and the next stream, but at least for the Federal Reserve, and the Bank of England doesn't peg its currency at all. Give me one second. The Bank of England doesn't. I know it doesn't peg its currency at all. So I would have to just kind of look into the Bank of England and understand the dynamics that are at play in the Bank of England. Yeah, I'm familiar with Liz Truss, and I'm familiar with what happened with that. Okay, thank you, Dr. Alex Sadler. Yeah, I didn't. I mean, I knew what was going on when it was all taking place, and I know that Liz Truss got kicked out after a few months, but I don't know what the actual. My assumption is the Bank of England had autonomy to set rates. That's just one assumption, and if they did, they thought that they were going to have to raise rates or were willing to raise rates because. I mean, all I know is, didn't Liz Truss say that she, wasn't she all for austerity or something like that? I don't know. One of them was all for austerity, and maybe the Bank of England thought, well, we got to raise rates to cool off inflation. So I don't, I don't know what the Bank of England was saying. Again, let me to your point though. To your point, if the Fed came out and said, yeah, we're never going to listen to the president, and we have full autonomy to do what we want to. And if inflation is a risk, we're going to rocket rates through the roof. Well, if that is what they said, if that's what the Bank of England said, then yeah, that's exactly what's going to play out, right? And you're absolutely right. Then we would see the yield curve do something more like this, right? You're absolutely right that we would see the yield curve take off if the policymakers, the policymakers are going to set the interest rate, are willing to go by the policy of higher growth, higher inflation means higher rates. You will get that feedback loop, and you will see that permeate through the yield curve. The point I'm making is, if it ends up becoming a ballot box decision, if Doug himself gets to vote for a candidate that's going to campaign on raising interest rates or lowering interest rates, I find it extremely hard to believe that a candidate would ever get elected that's going to say, yeah, I'm willing to raise interest rates. It would just never happen. And so my point is, there would never be the opportunity for a Bank of England to step in and say, nope, if Liz Truss's, and again, I could be completely wrong on the history of what happened here with Liz and Truss and the Bank of England, but there would never be a scenario for the Bank of England to step in and say, yeah, we're going to raise rates based on her economic policy that she's saying, right? Because I'm now the decider, and that would quickly, the private sector would quickly realize, or the primary dealers, who are really the ones who are showing up at the auction for these bonds, they are the ones that are going to be like, oh, okay, well, there's a profit to be had here, right? I can now undercut the person above me bidding because I know that there is a profit. All right. These are really good questions. I'm having a ton of fun with this. The idea that the market doesn't determine bond yields is insane. This is basic economic. Bond market investors demand a higher yield if they think inflation is coming. Okay. Yes, I don't disagree with that point, that there is a demand for higher yield if people think that inflation is coming. I don't disagree with that, but simultaneously there is the reality that the entire yield curve is determined by policymaking, right? Like both these things can be true at the same time. The other thing too is, I mean, this would be the other thing. If rates just drop to zero, you're not getting inflation anymore, right? We saw this in Japan. We saw this, and we continue to see this in Europe. We saw this in the U.S. in the 2010s, right? For 10 years, you drop rates to zero, you don't get inflation. It's the exact opposite, right? There's never been an instance of zero interest rates and runaway inflation. So it's hard to get inflation in the first place. So it becomes a cycle in which it just reinforces the low inflation to begin with. But the only way the yield curve itself will push higher. Now, what you could get is secondarily on the bank, like when the banks themselves are creating loans, they could want an increase the spread at which they are getting from the loans they are creating. But in terms of the yield curve itself, you're going to collapse and compress the end of the yield curve if once it gets stated that policy is forever going to be a zero rate. And the reason the long end, I mean, you and I will just, agree to disagree at this point, but my point is the only reason let me kind of do something like this. Let me think this through how I want to explain this. Fed sets rates higher. So I'm going to reduce this box. Help me out here with the causal diagram. It's a triangle if it's a question, right? So we're going to go, is inflation growth expectations rising? Okay. So I think this is kind of generally kind of how the causal chain looks. All right. So is yes, no. So I think I'm going to turn off this as well. I think we're all in agreement that this is the causal chain. Is inflation growth expectation rising, then the Fed sets rates higher. If not, then they're going to set rates lower. And then I think what you're saying, or kind of like where I'm coming from, is there is this next, and I'm doing this on the fly without really thinking, so I might have to will Fed raise rates in future? And so what I'm saying is, from an investor standpoint, I'm going to change this to a kind of a different color here to show this kind of the next causal link, is that there's this, then there's this, these are the, what you're calling the bond vigilantes here, right? Is the question is, will the Fed actually end up following, will this actually come to fruition? And then this ultimately determines where rates go, right? Like, is this going to actually play out from the bond side of things? And then if it does, this means that yields go higher, yields don't go higher, right? So these are your two options in terms of the outcome. And all I'm saying then is, you have this kind of, if inflation expectations are going to go higher, the current Fed policy is that the Fed states, or that the Fed is going to set rates higher, and that if inflation or growth goes lower, then it's going to set the rates lower because that's its stated policy. I'm saying that this is a policy-derived expectation of markets where they then want the higher yield on that asset. And my whole point is that once this decision factor gets removed, this becomes a moot point, because it's not a factor the Fed decides anymore. It's a factor of the voting, right at the voting ballot. So that is a little bit more, I think, how the causal structure works. I'm seeing some more questions come in, so we will continue on with this. Why did bond yields spike so much hard after the BBB passed? Conventional economics says it's because people were expecting inflation from too much. I don't think yields really, I mean, maybe for a brief moment yields spiked, but in the grand scheme of things, I think they're pretty much unchanged at this point. And again, let me rephrase that. As of right now, I agree that what you see is this phenomenon is playing out, because this is the causal. What my point is, this is the actual causal structure. It has nothing to do with bond market participants effectively telling the Treasury what they're going to issue new treasuries at. My point is, what is actually happening is the causal structure that I've laid out here, is that it's the market guessing what it is the Fed is going to do. Because if the Fed just simply said, we're keeping rates at zero forever, then there will always be an arbitrage opportunity for someone to undercut the non-bidder, because the additional reserves will always be there to do that. And you will get a bid. There will never be a point where a bid doesn't happen. I mean, maybe like in one auction, just because, someone forgot to set an alarm and show up, then it could happen. But at the end of the day, the yield, I mean, this is just, you could disagree with me, but if you want evidence to support that it is in fact a straight up policy decision, I would say look at the US from the 2010s, look at Europe from the 2010s, look at Japan. For 30 years, it was stated policy, the entire yield curve flattened. And it flattened because it was stated policy that this was essentially going to go into perpetuity forever. And that is the main driver, because it's investor expectations about what the Fed is going to do, not about what it is that they want in return, in some sort of return. It's the Fed and the Treasury is the dog, the market is the tail, not the other way around. I hope that helps. Let's see. I'm saying something, but I'm only saying yields go high because they expect, and I guess all I'm saying is the causal structure that you and I are seeing is different, right? What I am trying to tell you is, in my argument, you just disagree with it. I mean, it is what it is. But my argument is that what is actually happening is what I have here on screen. It's that this is the Fed decision matrix. If there's inflation and growth, then they're going to raise rates. If there's not, then there's going to lower rates. And that the investor is going to say, well, are they actually going to do this or not? And if they do, then that's why yields ultimately go higher. That it's not the other way around. That it's not yields go higher, which then forces the Treasury to issue at a higher rate. And then there's other things too, right? Yeah, and Michael brings up a really good point. There are other short-term dynamics, right? I mean, there literally can be a shortage of reserves at any given time with where the TGA is at, right? You can have just massive issuance of Treasury at specific times that can flood the market. Those are short-term dynamics that have to do with the immediate supply and demand, given this really what I would call an arbitrary or kind of cottage industry, this arbitrary market that got created by, that gets created by the issuance of treasuries to begin with. So I will do this. I will rewatch this stream in its entirety and think back through ukulele. I'm just gonna call you Debate Cat, if that's okay. Debate Cat. I'll watch through this one more time and think through maybe some better ways that I can explain that. So you're saying that people are not demanding extra yield due to inflation, even if they tell you they are, you know better than them. There is, I'm not saying there's not a demand for more yield when inflation expectations are pushing higher. I'm not saying that. I understand that asset allocators in the private sector as a whole want more yield when inflation pushes higher. And if you go to the very outset of the video, I was kind of talking about this exact dynamic about how high interest rates actually make a better kind of credit environment where banks and the financial sector can issue new money at a higher rate because it gives them this support to do so. So I'm not saying that is not a true dynamic. All I am saying is that the entire yield curve is still it's a monopoly price setting endeavor, right? And if the federal government wants to, they can crush the entire yield curve, and nothing will ever bring up the long end of the curve, right? They can do it. There's no inflation expectation that can ever bring it off the ground because it's monopoly set at that point in time. And my point is, the reason that there is the feedback loop of higher inflation expectation that allows the investor to get more yield out of the long end of the curve is because the Fed's stated policy is that they will do that when and if that ends up coming to fruition, right? And that is the mechanical feedback loop that is actually taking place. If you remove that part of the feedback loop, which is a policy part, then the entire yield curve collapses. And when it does collapse to zero, it reinforces the low inflation environment to begin with. Here would be another way of putting it. If the Federal Reserve came out tomorrow and said, we're going to set interest rates at 10%, right? Hell, let me, actually, I'm going to spit this out loud, and maybe this will just debunk my own thinking, but let's go to an extreme. Let's say tomorrow the Federal Reserve comes out and they set interest rates at 100%, right? So that they just jack up interest rates, right? My guess is the long end of the curve would not collapse to zero at that point, right? And let's just say they said this is going to be a permanent policy, right? It's going to absolutely collapse the economy, but interest rates are now at 100%. And if that's just the stated policy forever, the entire yield curve will converge to 100%, assuming how much it believes that is in fact stated policy for whatever. My guess is that is how it would ultimately play out. I would suspect the long end of the curve would push below the short end of the curve by a little bit, simply because there would be some suspicion that the policy could actually be held onto in perpetuity, right? I mean, I'm sure, pitchforks and stuff like that would end up coming out, but if for some reason we lived in a world where, in this example, we knew that for certain we were going to have 100% at 100 years, then I would imagine, my guess would be the entire yield curve would flatten forever. Okay, that was an awesome discussion, and I'm glad we went that way. Little derailed, but it was a good discussion, kind of how I want these live streams to go anyway. And given, as you guys can see here on the left side, I had a ton planned in terms of kind of the monologue. Yeah, absolutely. No, it was a great question. Feed it into ChatGPT. And just realize too, if you do feed it into ChatGPT, that ChatGPT has your history and it's informed based on your history. So like, I have to constantly prompt my ChatGPT, like when I want the counter argument to say like, okay, don't think like a post-Keynesian MMTer for a second, right? So, because it will always, I see people post ChatGPT answers and it's like, yeah, you're absolutely right. Doug's wrong. Well, yeah, your ChatGPT agent, is trained on your history and the memory that gets built. So just make sure it knows that. If you're going to use it wisely, I guess. Let's see. Yeah, it's a really good point, Ty. Not too much to do with reserves, guys. I'm going to do this. I will stream. What is today? Today is Tuesday. I'll stream later this week again, and I'll go over everything that I wanted to tonight. I'll have to change the thumbnail and everything. We'll go over everything that we wanted to tonight, in like a part 2. But what I did want to do, and I can hang out for a little bit longer, if anyone has any other questions or anything, and cut me off, that sort of thing. We can talk about something else, but I do want to go through some tweets. So let's do this. Yeah, I'm just going to kind of fire away here at some of these items. And if you have a question, two ways to get my attention. Definitely the best way to get my attention is going to be super chat. By the way, Ty, I never got you up on stream, but I appreciate the $10 Canadian super chat. Hopefully Trump doesn't pass a bill, hopefully Trump doesn't pass an executive order on live stream super chats where this gets tariffed, because that would be bad, but it would probably turn out to be illegal anyway. So that is the good news. But thanks for that, Ty. I appreciate it. But if you do have any questions, put question in the question. That'll bring it to my attention, and then also obviously super chats will get answered and fully engaged with. All right. So number one, I tweeted this out. It does look like, the courts unanimously so far have found the tariffs illegal. This will likely go to the Supreme Court. The reason this matters right now, and we'll find out, likely in March, possibly going to June. And if they do get found illegal, the whole essence of the current lawsuit is that there ends up being a refund. We're at getting close to that $50 billion a month mark. I think we were over $30 billion for August, but we could easily be, especially if we get to June, close to 500, if not at 500 billion in terms of a refund. March might be a little bit less than 500 billion, but that's going to be a massive refund. So far this is big, and if they do get refunded, this really changes, in my opinion, the trajectory of what 2026 is gonna look like. So far, first step, really big, but this is, I think, ultimately going to go to the Supreme Court. Next up on the list is, this was I thought was a good tweet, is this idea of the inflation feedback loop. And one thing I wanted to point out that Warren stated here is not only is everything in here in terms of kind of the post-Keynesian feedback loop idea, and I made a video about this as well, but that it also deteriorates the effect of public debt, and that in real terms, public debt is really what matters. And that's why, if you're over at AppliedMMT and you're a pro subscriber over there, that's why this chart is one of the most important charts. Every time we go negative in terms of rate of change, in real terms of deficit spending, we get a recession. And it's in real terms that government spending really ends up mattering. So the first order is just the rate of change, right? If you think about it from a pure math standpoint, if you have the same spending as the year prior from like a GDP perspective, that means no growth, right? You have the same amount of GDP, the same flow measurement for the next year that you did the year prior, right? So you have to have accelerating flows to get accelerating growth. And so even though we didn't have a surplus, like an actual nominal surplus in, say, 2008, we had a real surplus. So both inflation adjusted and in terms of rate of change, we weren't getting enough additional spending to offset the credit contraction. And that's why you end up seeing bubbles burst, when in real terms, you get a negative turn in the amount of government spending. And then the real side of that is, if you just think about it, if you have all your discretionary items that you have to pay for, right? So here's your entire allotment of money for each week, each month, whatever you want to call it. And let's just say things like, we'll call this gas, and we'll call, you guys get what non-discretionary items are. So this can be, this can be your entire non-discretionary bucket, right? And then the discretionary bucket is everything else that's in this area, right? Well, when things like gas or anything else, toothpaste, or I don't know, I don't do the shopping, strawberries, right? Is the non-discretionary items kind of went out, that usurps the space for other spending. And the amount of each new dollar that gets issued, right? So if every new dollar, so as this grows, right, as every new dollar grows, So you can imagine the green box being the amount of new money that you're getting. Well, if things like gas or just the cost of living grows even faster, you end up squeezing out what goes to other kind of non-discretionary items. And then even in the worst case scenario, you get to a scenario where the amount of new money is just no longer able to support even the basic economic engine. And that is how you end up getting a recession. So going back to this chart right here, that's why this is so important. And if you are an active investor, active trader, you want this and you want to be tracking this. That's why this is so important. And also, I mean, as it stands, based on the current calculations, by the beginning of next year, we actually will be negative in real terms, right? We are collapsing. We are seeing a massive deceleration continue. And that's why the refund is so important. If we get the refund, we're completely fine, nothing to worry about. But if not, then we're going to be in really rough shape. I see some questions coming up, so let me pull these up. So going back to the percent change debt chart, both government and private sector is falling. Is that a headwind or growth? Yeah, okay. You're talking this chart right here. This is a quarterly chart. I can zoom in on it. This is a quarterly chart right here that ends in Q1. As it stands right now, we're actually seeing credit accelerate. We have some real-time trackers for credit. The H.8 is a good one as it stands, and this will update in the coming months as the quarterly data comes out. We are actually accelerating at this point in time, and we knew that we would be accelerating. And the reason we knew we would be accelerating, Mel, I know you know all this, but this is me just kind of talking a little crap to all those who gave me crap back in 2023. The reason we knew we were going to get an acceleration is because we had the big acceleration from the interest income going the other way. And so, yeah, I mean, we're seeing the pop in credit exactly as we'd expect to right now. So as of right now, no, we're seeing growth. These darn taco tariffs are preventing my Lego orders from getting in. Yeah, man, when the Switch 2 launched, that really sucked. We were in the same boat. I don't know what else. Have we had any issues since then? I can't think of any. I don't know if I've had any issues at this point in time. We are in a bizarre world where Trump has the opportunity to prove MMT right. Yeah, man, I think I made a tweet about this or something like that. If you bring rates to zero, inflation doesn't spike, that will be game, set, match for MMT. Yeah, I mean, I would say, speaking of 2022, that to me, that was the greatest petri dish science experiment we could have ever had for some of the core tenets of MMT. I mean, it played out exactly as we were expecting, exactly as we were anticipating. And I was quite pleased with how that all played out. Yeah. I mean, it's the world we're living in. It is wild to me too that the right is kind of like they both want the end and are completely fine with the end of liberal capitalism that we've had for the last 60 years. But so be it. That is the world we live in. It was fun while it lasted. All right, let's see. What else do I got that I want to touch on for a little while? Let me think. Were there any others? Okay, yeah, this is actually okay. This is something I wanted to touch on, going back to this idea of one of the main feedback loops, the negative feedback loops being wages pushing higher. And I'm just going to give my take here, my kind of policy take. Just reduce the work week. The measure reduces labor costs and the money demand. And my overall thought on this is do you then just stop people from working? I mean, let's say someone like me who wants to work 60, 70 hours a week to get ahead. Yeah, I don't know. I think this is such a tricky thing to do, because at the end of the day, it's human nature to want more than the person next to you. And there are people who are going to want to take the risk, who are going to want to give up their time for that. And I just find it hard to say that that's something that would even end up working unless you force people not to work. And then you'd also have to stop on the demand side, like the continued upward swing. I find that kind of dangerous, and not anything. I don't know. Yeah. Okay, working from home is a completely different thing that I would be okay with, but. Yeah, I guess I am too much of a free market capitalist to say that this is something that the government should be meddling in. Because in my opinion, like you can go live especially in the U.S., you can live a perfectly content life on a reduced wage, but like people want new cars. They're not content with 1,000 square foot homes. They want 3,000 square foot homes, right? It's one thing if you want to work less and you're just content with less relative to the population as a whole. But what I hear when I hear people say reduce the work week is we want to work less, but also get more out of it. And I don't think there's anything stopping you from just working less, right? Like I don't think I just don't think I think you're completely allowed to in America to just work 20 hours a week if you want to and be compensated as such. Yeah. Anyway, those are my takes. Maybe they're too hot of takes. It's not what I wanted to do. Maybe we will look at that later. Let's see. Okay. This is another tweet that I thought was probably worth discussing. Trace the source of that risk capital back to its origin. So this clip has Jeff Bezos saying like the thing why America and American capitalism is so exceptional is because like there's just so much willingness to take risk, right? $50 million for a 1 in 10 chance of having a successful company. And the point I was trying to make with this is just simply that the reason this whole scenario is what it is in the US and why Europe has never been able to achieve this despite having similar banking laws is simply because the US has such a strong fiscal expansion, right? There's so much fiscal spending, and you can trace back the risk-free capital to government spending. Like that is the whole point, is that we add so much risk-free capital that it's so easy to take big risks. And there is a pass-through from that government spending into the financial sector that plays out that we talked about at the outset, and that it just all goes back to fiscal. And I think a lot of people didn't get this. they didn't understand. So a couple thoughts on this, and Henrik is just a constant kind of straw man troll. So I mean, I'll let it be what it is, but how many countries have more deficits and less risk capital? It's down to culture, not money printing. And the point here isn't to say that you can't have a country that just prints into oblivion that's not going to get the same outcome. There is an institutional structure that has to be in place, sound banking, right? I'm not denying that a sound banking system, a just banking system is a necessary precondition for this to work. And I would never say that the opposite isn't necessarily true, right? That this is always going to be the case. My point is, if the U.S. did what Europe did and impose austerity, right, which we are kind of doing with the tariffs, which if they continue and they turn out to be legal, we'll be in the same boat as Europe, is that it's the capital injection that the government is giving that allows the banking sector to do what it is that they're doing, right? And on the flip side, there's other ways to get this. The U.S. doesn't have to spend to achieve this, right? I mean, in theory, we could just start exporting more than we're importing, and that could give us the capital injection that we need to then hand off to the private sector to leverage. Now, what we'll do in that process is we'll inflate ourselves away and simultaneously give someone else like China and maybe the now kind of new Asian bloc that's rising, the power that the US dollar had, right? So we'd be abdicating that power and giving it away. We can do that, and it would just end up looking differently, but a very similar outcome would happen. So that was one thing that I wanted to touch on. Yeah, and then this is just, again, the U.S. spends more because it has more capital. The other countries can't catch up by spending more, but they can by accumulating more capital. And like I'm not saying that this isn't, like, in one sense this is true, right? Because the rest of the world exports to the US, they want the dollars, and then they leverage those dollars up. They call this the euro dollar market. That's true. But that's a policy decision. They don't have to do that, right? Like, we're seeing potentially right now China, Russia, and India all come together and say, yeah, okay, we can do this. We can do what the US is doing ourselves. We'll make a policy decision to do this. And it's just that. It's just a policy decision, right? And it can work to the benefit of another country. It doesn't have to be the U.S. So I'm not saying this is the natural order the U.S. does this. I'm just saying this is just actually how it ends up functioning. Let's move on to the next tweet. Yeah, I'll jump to this later. I don't have. Oh no, I do want to talk this through. Okay, this is actually a really good one, and I wanted to spend some time on this. With regards to the interest rate. So Colin Roche, who's done just a phenomenal job with his ETF, DCSF, I think is the ticker symbol. I might be able to pull that up on a second screen. I think while the S&P 500 is up like 50, 60, 70% since his ETF issued. His ETF is down 40%. It's amazing how right this guy has been. The point he's making is, essentially you've got to be an idiot to not realize that higher interest rates actually brought down inflation. And my counterpoint here, and hopefully I can just kind of walk through this, is that to understand the impact of interest rates on total demand, you need to calculate two sides of the coin. You need to calculate or estimate what the cost is going to be for the higher interest rates. And that's relatively easy. Just a simple spreadsheet can do that. But you also then need to calculate what the reduced amount of demand that you got, or the reduced, really what the reduced amount of demand is going to be on credit itself. That's a little bit more difficult to estimate. And in fact, you need like system dynamics as well. Charles, we'll get there. We'll get there. We got a little derailed by a different discussion, so we'll get there. Maybe part 2 of this stream later this week. We'll get to there in a little bit more detail. It also got derailed because of the mic issue as well. So I apologize. I apologize about that. But part 2, we'll get a little bit more into the investment strategy side of things. Put it all into Bitcoin. That's a great idea. So, but based on my kind of back of the napkin calculations, I think it was something like that you'd get essentially 400 billion. So I think I calculated right around 8 to 9 trillion in either the issuance of new loans or the cost of current loans, and the cost increase that would have would be right around 400 billion from 0 to 5. And then on the flip side, it turns out that's exactly the same amount given where public debt to GDP is on the interest rate side of things. And so when you put those two together, it essentially is an offset, right? So you're getting additional demand, and it is lagged, right? I mean, it took 6 months it took 6 months for the interest income to hit, but essentially it's offset, 400 billion to 400 billion, no real difference. And my point was in 20. So let's just take the interest income and the cost increase out of the equation for a second. If you then if I just told you, hey, the government is going to confiscate $700 billion worth of wealth from, we'll call it March 15th to April 30th, what do you think the impact of that? What do you think the impact of that is going to be, right? So essentially a reverse stimmy in a month and a half. What is the macro impact going to be of that? It's going to be devastating. Anyone is going to tell you it's going to be devastating to remove 700 billion worth of financial wealth out of the private sector in a 6-week period. And yet I'm supposed to believe that a net zero change between rates and additional interest income would offset inflation more than a $700 billion impact would. If you're going to tell me that, then you also have to tell me that the government spending added nothing to inflation in the pre-COVID era. right? So, there's a reason that this guy can't forecast anything, right? And he can only have opinions on the backside. It's of events. It's because he just, it's simple math to me. But that was really kind of the main thing. And then this question was, how do I get to that calculation? And that's how we do it. So there's that piece to it. Let's see. Last up for the night, I think I'm going to go with these two, at least in terms of the tweets, and then we've gone over the tariff stuff. Was this kind of final idea too, just to kind of drive this final home point that we started off with. And I guess I've pretty much driven this home enough. So this whole point about what I'm trying to make, and there were a few other kind of caveats to this, just in terms of the kind of what government spending is. And, one thing that's always important to keep in the back of your mind when it comes to government spending is that as long as it's priced in the currency that the government spends in, it can be purchased by the government, right? That there's nothing that will ever stop the government from being able to procure the sales of goods and services that are being made by the private sector for government use, right? And that is like an important MMT 101 idea, and this is why Mosler takes that from that point to the price level itself ends up being determined by the government spending as well. So I mean, a way to look at this is if the government, let's just say the government only ever bought oranges or whatever, right? And that's all the government was ever going to buy. And they bought that orange, every orange for $1, right? Mosler's point is from that single orange, you'll get a relative pricing that will essentially settle based on a $1 orange, right? And so that's why when the government buys gold and for $30 an ounce or whatever, everything can also be priced in gold, because it all becomes relative to the exact same thing, right? And so you'll see the entire price structure of all goods and services level around what the government is willing to spend for that kind of anchor price item. Of course, the government is buying a lot more than just a single item, right? I mean, a lot of what the government buys, of course, is labor. The other thing that it buys is like things like Social Security, right? Essentially like a retirement check. So, what should you be paid to do nothing but consume? Various welfare elements. So those are the things the government is buying and setting a price structure where from there, everything, everything goes up from that point. And I think it's just an important kind of theoretical underpinning with regards to government spending. So those are the main tweets that I wanted to hit on tonight. I'm getting chat jumping off here a little bit, so let's turn back to that and go through some of these messages. Keep working, but don't come in the office. Relearning economics isn't your real name, Ty Lopez. When are you coming out? Here in my garage. Oh, I miss those original Ty Lopez YouTube ads. That was peak YouTube for me. Here in my garage. Speaking of my garage, I built I got to ask you guys about this. I think I might do it once I hit, like, if I can hit 100 concurrent subscribers. I know I'm only a quarter of the way there. We've gone up to 40 or 50 before. I think I really derailed the stream with the mic, but. Speaking about my garage, in my garage, I built a golf simulator. I've been golfing a lot in said golf simulator. I'm curious, and I would start another channel for this and kind of promote that, but and I've tried to do this in the past, but I'm curious if I were to hit some golf simulator, talk tweets, talk chat, would anyone be interested in that? Is that something that anyone would even show up? I'd still talk macroeconomics, but it would kind of give me something to do while I did this that wasn't necessarily directly tied to my computer. So I want to do it. Let's put it that way. I want to do it. All right, some back and forth. Have you reached out to Jason Buck yet? He knows MMT. I have not. I know you mentioned that name last time. DM me again. Yeah. If he has Twitter or anything, send it to me, and so I can kind of check him out. I like that. Capitalism is like a pyramid scheme. No, it's like the Washington Monument. From the top, you think it's a pyramid scheme, but from the ground level, you realize it's just a giant building. What are your thoughts on the financial sector and markets? It fluctuates. Yeah, let's do this. Let's talk strategy. We'll dive into strategy here. Give me 1 second to continue to consume some Pellegrino. Do it. I've gotten good too. I've gotten good at golf. I will let you know. Let me rephrase that. I've gotten good at simulator golf. It translates a little bit out of the course, but I'll tell you what, when you're hitting a ball off like hard ground versus, your nice, the nice mat turf that you have in the simulator, very big difference. But I've gotten if you want to get into golf and you want to get better at golf, building a simulator is definitely the way to go. All right, give me a second to get one thing set up here, and I want to open up. You guys can't see this, but I'm opening some stuff up elsewhere. There we go. That's what I needed. And I want this one. One more second. One. Let's see. What I'm doing right now, which you guys can't see, is I'm pulling up a chart of asset allocation. And we can go over that. We can dip our toes into the strategy portion of this. Let's see. I want to create a new scene. Is it going to let me paste this? Good. All right. So now I'm on a new scene. I can paste this, and you guys can finally see what the heck that it is that I'm talking about here. So we were just talking at the outset about the business cycle. I got to clean this up. We were just talking about the business cycle. And this is kind of how it then translates into, this is kind of how it translates into actual investment strategy, right? And you can break this cycle down in many ways, but the best way to kind of think about things is kind of through like a phase sense. So in this instance, we have an X and Y axis of inflation and growth, right? So you can envision that the cycle goes from, right, any given business cycle will go from, like, this would be like inflation. Well, actually, this will be growth, right? So growth takes off, it falls, it comes back up, right? You have this ebb and flow. And then you also get inflation that, will follow growth, and then it'll collapse after growth collapses, and you go up and down. Ty, what's the LOL for? I'm curious. Did something happen? So that's kind of the inflation growth cycle, where you get falling or rising inflation, falling or rising growth, and that puts you, at any given spot in the business cycle. And if you think about it, if you want to draw this back to the credit cycle and the fiscal cycle, right? As the credit accelerates, that means inflation is likely going to be accelerating as well. That's the main endogenous driver of inflation. And so, you could essentially say that the credit cycle precedes the inflation cycle. So as inflation's rising, just kind of insert kind of, not perfectly, but credit would be rising at that same time. But let's just take the inflation growth cycle and build an investment strategy. And this then starts with a concept called like risk parity, right? Where the idea of risk parity is that there are there is a cyclicality to the business cycle, and that essentially every asset at some point, given long enough, will have, its time to shine in the business cycle. And that really what you want is, if you want to get the entirety of the yield that can be derived, and the return that can be derived from all financial assets, to spread your risk equally based on all asset classes available, weighted to how often you're in that kind of quadrant, right? And on a first order standpoint, usually where you end up in terms of like growth returns is the vast majority of time you're in increasing growth. 75% of the time on the downside, 25% of the time you'll have collapsing growth. And then that's split sometimes between like a stagflationary and inflationary environment. And so from there, I don't know if, Hamel, the people who actually invented this was Ray Dalio, Bridgewater, Markowitz to a certain extent. This is all just an extension of that. If Hedgeye is doing this, they stole it from something, they stole it from the Bridgewater, they stole it from the Bridgewater risk parity concept, right? Like this is all coming from that school of thought. So then the idea is given where flows are at, now let's determine, what part of the business cycle that we're in. And this will eventually get to Arya's point about, what happens with financial stocks, right? So let's start with, if inflation starts falling and growth starts falling, like what's the best thing to do? And think about what type of world that would be, right? That'd be a 2008, it'd be a dot-com bubble bursting, right? That's the business cycle coming to an end, right? The worst case scenario for the business cycle. And what's going to do best in that environment, right? You're going to have like the dollar is going to do well, cash will do well in terms of what it will yield. Treasuries will obviously do well, they will go up in value. And then if you had to pick some sort of stock relative to the rest of the market, your absolute non-discretionary utilities, healthcare, maybe something like a Procter & Gamble is going to do best, right? You have to buy deodorant, toothpaste, shampoo, you have to keep the lights on, you have to go to the hospital. And shorting would absolutely do well, right? Yeah. So if shorting would do well in this instance. So I think I created this exact example for someone who runs a long only fund. But yeah, shorting, puts, that sort of thing would do well in this category. And so this would be like the absolute end of a business cycle. Now, if I were to translate this back, right, let's jump quickly back to, can I just duplicate this? Give me a second to just duplicate this and bring back actually, you know what I can do? Never mind. I will go here. Yeah, we'll just go here and we'll copy this and we'll bring this back into here and we'll expand it. And so, what we would know then is, when kind of based on what we're saying, is like in a 2000, when I got to come up with a different color here. In 2000, fiscal's dropping, right? So we have this drop in fiscal and we're getting this accelerating credit bubble, and we know accelerating credit bubbles can't be maintained forever, right? So we can now forecast, okay, in 2000, right? Let's just say in 1999, right? Where are we? Well, we're kind of close to growth falling on the y-axis, and we're starting to get this kind of inflation thing playing out. So like, we'll call this 98, right? So inflation's rising, 98, 99. All of a sudden you get 2000 where growth is actually starting to, we'll say 99, inflation's rising, but growth has been kind of precipitously falling in that time frame. And then all of a sudden, bam, and the phase jump happens quick, right? You don't have to linger in any given phase. Bam, you end up quickly falling and collapsing. Or this would be a very similar look as to what happened in 2008, right? And this wins out and obviously puts and everything. But then what ends up happening is you immediately get this scenario where, so now let's just say we're in like 2003, right? We're at the bottom. Bonds have done everything that they're going to do. The dollar flight to safety happened. Markets had bottomed. It's 2002. All of a sudden, you're actually seeing now the immediate aftermath of the automatic stabilizers kick in. If you recall, back in like 2001 or 2002, we got Bush stimmy check for $600. So that all hits. So what ends up happening is you get this immediate push higher in growth, but inflation's not picking up yet because the endogenous cycle hasn't started, right? We're still, a year or two out from the endogenous cycle. You get this immediate pickup in growth. And now what you really start seeing take off is things like tech, anything that's going to make stuff more productive and lowering costs. So stuff that's just going to, inflation loser type stocks, right? And so you see this immediate pop where you get those sort of winners. And then eventually what ends up happening, this will finally get to your point about financials, you actually start to see the financialization take over. So now you're looking at 2004, 2005. Now, this doesn't mean that tech stops winning, right? Or that any given sector can't continue to win. But all of a sudden, the financial sector really takes over and inflation starts to pick up. Growth is still humming along, but this is where you start to see the things that just weren't ever seemingly winning now take off. And this is where something like bank stock, financial stocks can start to come in and win the day because they're going to benefit from the higher rates, the higher spreads, the higher financialization, but it also sows the seeds of that given bubble. And then you rinse and repeat. And then we're back to 2007 into 2008 before we end up collapsing the cycle. So that's the cycle, and it can be expressed both in kind of growth and inflation and in terms of just kind of fiscal, where we're at in the fiscal and credit, and all these things are kind of telling you very similar looks to where we're at. And that's why, with the system dynamic models that we build, that Ty and I build with modern macro tech, it's so important to be able to see not where we're at today, but where is the market, where can we get ahead of the next pricing in, right? And this is what's key. This is also kind of the other cool thing too, right? Is we can see things take off, and it can tell us also there's a reverse kind of feedback information loop, if you will, where if we see certain commodities, certain stocks, certain sectors outpace, that can also tell us, hey, this is what the market is expecting, right? This is the market expectation. Now, our research has shown that you can pretty much get that if let's say the big crash is coming in a year, right? So you want to get treasuries, cash, you want to get utilities or healthcare at the best price, you want to get fully hedged. Starting to make those moves about a year out is how you will capture all of that move, right? And slowly but surely, what happens is the market realizes that move is playing out, and then eventually it fully realizes it, but it doesn't realize it until it's too late, right? Like the market came to full realization that we were in a very, very bad spot in October of 2008, right? But if you wanted to get the entirety of that move captured in terms of returns, you needed to get into that move in like October of 2007, right? And by the time that you realized that we were in a bad shape and the dust had settled at early 2029, that's right when the market started its march towards, I think we ultimately bottomed in like March or April or something like that of 2009. That's when it started its march towards the next move higher. And so you really want to be a year ahead of that. And the reason that we've invested so much in the technology we're building at Modern Macro Tech is because we think the only way you can really get that forecast a year out is through that sort of target. I hope that helped. I hope that was informative in terms of at least the first kind of mapping. We'll go in more detail. I've got some stuff that, again, I wanted to show, but since I built all this out, I can probably build it out a little bit better. We can show off the 3D dot plot. And then I also have this cool chart here that shows the first and second derivatives. I'll show you the first derivative. So here is the entire history of this chart as a scatter plot going all the way back to 1950 or something. I think these dots, 1960 is where this chart starts. And what you can see is, the vast majority of time we are in rising credit and rising fiscal. But if I can zoom on in here and let's go to that 1996 we'll go to 2003 period, and then I'll pull this all in so you can kind of see it in that more quadrant specific. So if we start here in 96, we still have government debt positive, government debt dropping. So we're looking just at the axis now. It's dropping, but as it's dropping, we're now getting that accelerating credit. And then you get that inflection point right here. Notice how government debt continues to drop as we hit 1997, and we get a deceleration of credit, and that's ultimately when crap hits the fan. And so you can kind of see that visually play out in a chart like this. And the reason the second derivative happens is this can give you, especially when you're getting really high volatility at the second derivative, it can give you a quicker view of what quadrant you're in, right? So it's obviously super noisy, but if we do that same 1996 to, 2003 chart, you're going to see it, evenly distributed amongst the quadrants. And now you're seeing that massive acceleration, then deceleration in credit. We're getting a deceleration in government spending before we finally see that taper out. So now you can see the acceleration and deceleration much more quickly, much more pronounced when you get in the second derivative. And so when you model this stuff out, it's important to jump between first and second derivative. And generally speaking, the rule is that we've determined, the rule is the rule that I just made up because we're the only ones doing this, is that the market is most sensitive to the first derivative the longer data volatility is being compressed. All that to say is when shit hits the fan, the second derivative matters more because now things are happening very quickly. It's more sensitive to the second derivative. When you're very long in a cycle, the first derivative is really going to be a little bit more important to what the causal outcome is going to be of the move in the data. And so that's why we kind of look at first derivative, second derivative when we model this stuff out. So I will clean this up for next week too, to give a little bit more, and I'm going to have to see how this shows on stream as well. Maybe make these dots a little bit bigger. Maybe I'll even post this so you guys can play around with it when I stream. So yeah, that's how we convert theory. That's how we begin this process of converting theory into actual kind of investment, into investment strategy. So there's that piece. If you made it this far, hit that like button and make sure you get subscribed for the next stream. I think that's kind of it with questions as well. Yeah, glad to chat. Let's see, Michael, I took the kids mini golfing and there was a driving range there, and I watched a guy who had the smoothest swing, barely an effort, made the ball sail for yards, super straight. That's what I'm attempting to get at. That effortless swing. It's a lot of effort, but we're getting there. I got to get a new driver. I broke my driver. I just haven't, I didn't, I had 4 kids, life got in the way, haven't had the opportunity to do stuff like this. And, now I'm able to do it. So I got to get a new driver first. Cause I literally, the face, like right on top of the face where it laminates to the head of the club, or like the face of the club to the body of the club, sheared, and I was 20 years old. So I've got to figure out something new. I'm literally using my son's like starter set driver right now. I want to get the swing down before I go invest into a new driver. So even with a starter swing driver, I can still carry it about the starter set swing driver that's an inch shorter than what a man's driver would be, and is like a 10.5 degree loft, or maybe even 11 degree loft. I'm still carrying that thing 260. So I feel like, I probably don't need to justify it to you guys that I just need to go buy a new driver. I think I need to justify it to my wife more. So that'll be that for that next week. So yeah, maybe I'll give that a shot once the stream gets a little bit more traction. Let's see. Getting a question in late, but very interested in learning more about your service and how to leverage in terms of market timing. Yeah, man. Hit me up on Twitter DMs, and we can certainly talk more. But essentially what you see in these streams is what I go to in very targeted detail in terms of timing, right? So what I pretty much am doing when I break down the kind of the market analysis is actually what I can do. Give me one more second. I'll get to that, and I can kind of go over something very similar to what the most recent update looked like. So we have quite a few. We have quite a few timing tools, right? So I mean, everything I talked about in the chat today, I build out in kind of more sophisticated tools, and we go over things in just a bit more detail. But and actually, what I can do as well is pull up. So here's the AppliedMMT site. We have four kind of core models. Two of them I would call flagship, the first one being DeepMMT. And if you hit me up on Twitter, I can get you a link to some of the kind of historical calls that I've had on Twitter. But DeepMMT is just kind of a flow following deep learning model that forecast where the S&P is going. And actually I can just jump to Twitter and show, I think I replied recently with exactly that. Like here's the DeepMMT model. And again, if you go to my Twitter, I have receipts going all the way back for 2 years about what the model looked like. This was the call from back in May, at the near bottom of the main selling. Throughout the entire sell-off in April, it was saying markets were vastly underpriced, and it was looking for a big rally really into the end of the summer, with that kind of drop off that we saw, and then a continued rally from there. That is kind of one of the kind of receipts that I have. And if you go back over time, you can see the various calls that it's made since it goes back. I mean, I think a great call, this is going all the way back to 2023, was this call for the big drop in 2023 that it saw with the big recovery at that point in time. So this is one of our flagship models, DeepMMT. We also have kind of a flow, what I call a flow phase model, which is more kind of longer term, in the sense of like it just gives like kind of the macro, like the macro look of where the economy is at that point relative to actually that fiscal and credit cycle. Those are the two main inputs, and that's what that model is. And then we have a couple other kind of models that are like that. And then we also just have the raw data like you're seeing on screen right now, right? And we also have daily treasury statement that shows where flows are at. And I'll look at this in every single update, and we'll understand where are markets relative to flows, and are we overpriced, underpriced? We have various models and data to understand that. And the idea isn't to try and time every single move. That's certainly not how I'm playing it. Some people use a lot of options, and they create various option strategies to understand where we're at. Some people, like myself, have a bit more of a kind of sector rotation type, or kind of, I like to call it aggressive, like how leveraged am I versus not leveraged, like how risky is this market to be long versus not long, how much of a buying opportunity is this market to be. So that's pretty much what the updates look like. And for the most part, like every update I start with, and this is kind of a new trend that I've been doing. This is from a couple weeks ago. What are the tailwinds? What are the headwinds? Where are we at? What are some things on my radar? Oftentimes I'll go into a little bit more detail on a tweet or a YouTube series that I've talked about, just to kind of give some more insight that's more applicable to the here and now, kind of why I made it. And then we go over all the data and, come to kind of a conclusion in terms of exactly, what it is that I'm thinking about where the market is. And for the most part, I have a video out at least once a week that goes over all of that. And then there's also too, if you don't have 20 minutes immediately, we have a nice little summary sheet that you can read that goes out in the email as well. And so that's kind of the essence of what the pro subscription is. So if you want some more info, by all means hit me up, but that is kind of the essence. Here's some of the notes and just some of the ideas and stuff that we talked about in the most recent update, and some ideas about the deep learning model and kind of how to interpret it, on top of course, going through all the data that is within the updates that I just showed you as well. So that's that's where we're at with that. Another question. You had mentioned that with the loss of Fed independence, we could see sustained zero interest rates. What quadrant does that put us in? Yeah, good question. If that plays out, and again, it's a big if, right? I mean, it has to play out. But I would say that would definitely put us back essentially where we were at in the 2010s, which would have been this low inflation, rising growth where tech wins out. That is where I would anticipate something like that being. I mean, I think we would kind of ebb and flow very much like we did between these two quadrants. If that were to play out, the caveat, the big difference that we have here right now that is concerning to me is if the tariffs end up being found legal and we're able to essentially wreck our place, the U.S. is able to like wreck its place as the dollar's place on the global stage, then that does change this a little bit, right? I think we have a little bit more of an inflationary tendency at that point in time, and things get a little bit more dicey. But for the most part, I mean, I would expect us to revert back to like a 2010s type economy. Okay. Well, we went for 2 hours. This was fun. Sorry again about the audio at the outset. I am going to finish the stream and go fix that audio, but yeah, or go cut that part out of the stream. But yeah, this was fun, and I think that's all I've got. So everyone, thanks for tuning in tonight, and yeah, as always, good trading and follow the flows, and we'll talk to you next time. All right, take care, everyone. Bye bye.